All right. What is up, traders? What's up, tycoons? Super excited for today's video. We got to talk about the bond market, right? We have to break down TLT. We got to take a look at some of these treasury yields, and we're also going to take a look at some other ETFs we normally don't look at in today's videos. We're going to break down the TMF and the IEI. So be sure to stay tuned through the end of the video. Smash that like button, subscribe to the channel for more, and we'll go ahead and jump straight into it. So the very first one that we are starting off with here is actually going to be the IEI. This is a little bit more of your midterm bond ETF versus something like TLT, which is, your 20 plus year bond ETF. And there's two ways to look at this. Okay. Number one is going to be that we came down to the golden pocket, right around our 61.8% retracement level from the all-time lows to the all-time highs. We had a big move up, retracement, and now we're going to look for the continuation to the upside, right? That's what the bulls are going to tell you. Now, remember, this is a monthly chart that we're looking at, so this is not going to happen anytime soon. Now, the bears, they're going to tell you that yields are going higher for longer, that they're going to stay elevated higher for longer, and that this could potentially be one giant bear flag or bear pennant in the form. Right. I mean, if we zoom down to the daily time frame, we can see the triangle pattern forming, more in this area, and we're very close to breaking down to the downside of it. So, that is something you need to be cautious of. But if you're the type of, trader and you want to, essentially try to time when the Fed is going to cut rates, and you think that the Fed is going to cut rates soon, or sooner than later, then this is something that you could potentially play. And ultimately, you would be actually looking for a breakout to the upside of this triangle pattern, right? Something like this, all right, and get the breakout to the upside. So I just wanted to highlight IEI real quick. Let's actually break down some of these treasury yields, because that's what you really need to pay attention to in the bond market, right? And we'll go ahead and throw some line charts up here, just make things very simple. And look at how well these levels were respected, guys. These levels were respected very, very well. If you take a look, right, old support becomes new resistance, and we're attempting to put in a double top up here on the 10-year treasury, right? So this is the first one we're looking at, is our 10-year treasury yield. Now, one misconception about a double top is we have to break this neckline, right? That would essentially make it a real double top. Just because it's having old resistance and battling old resistance doesn't necessarily mean that it's a double top. Okay, that's something that we need to be mindful of, right? What if it comes back up here again and breaks out, right? Then it could invalidate that double top. But literally that 4.254% level, was again our old support, turned to new resistance, and yet again it was resistance again, and we've seen a drop in the 10-year treasury yield. Now, I actually put this chart out in one of my most recent newsletters, right? If we actually go over here and take a look at the newsletters, okay? If you didn't know, I started a completely free newsletter for you guys. It's really good, great content. And, take a look how in the newsletter, right? We're taking a look at it. We highlighted the 10-year treasury yield. We went over these levels as we are approaching them. Okay. And what do we see in the chart now? We've rejected it. Not only that, we also broke down the 30-year treasury yield. And we would go over why this matters, different things. It's a really, really good newsletter. We also talked about the 30-year, 10-year spread, and how, the closer this goes to zero, essentially it can signal a flight to safety, often indicating a lack of confidence in the strength of the economy. So, lots of good stuff that we cover in the newsletter. It's completely free. Not only is there good investment intelligence in there, but also, there's really good trade ideas and different things in there. If we take a look at the commodities report, one of the ones that we talked about was the London sugar futures. Okay, talking about London sugar futures, this was the chart. If we go back to our trading view and take a look at the London sugar futures real quick, we can see that that trade actually played out pretty nicely, right? Zoom down to a daily time frame. All right, and you can see, even on the line chart here, what did we do? We came up right to that target there and actually hit that target. So, if you guys are fans of the channel, if you're also fans of, free trade ideas and free trade setups, as well as overall investment intelligence, I do highly recommend signing up for the newsletter. There's a link in the description and also in the comment section down below. We're going to take a look at the US 20-year treasury yield. Okay, break that down as well. You can see again, it's showing signs of a double top. Ultimately, we need to break our necklines here for it to be a confirmed double top, and then it would form more of that M pattern, right? The infamous M pattern is when we would ultimately get a real double top. But for now, we are, showing signs of trying to put that double top in, hitting resistance even on the 30-year, which Bill Ackman is also famously short 30-year treasuries, meaning that he's long the actual, yields themselves. And while this one is attempting, again, to show signs of a double top, there's actually a key level that I was highlighting, right? And that we highlighted in the newsletter. You can see that there's still a little bit of things to be worried about when it comes to the yields, right? We have this area here, old support becomes new resistance, right? And that's what we're seeing. We see old support, and now it's trying to act as new resistance, but we keep getting above that level, and we're actually trading above it right now. So we need to be cautious that, we're not actually potentially flipping this to support and trying to head up higher to 4.818. 4.818 is a very key level in the past as well, right? Support, support, and then it turns to resistance, resistance, resistance here. It's very possible that above 4.2 on the 30-year treasury, we continue to climb higher. But for now, a lot of the treasury yields are showing signs of potentially topping. We'll have to see, how that really develops. We have some important data coming out tomorrow, right? We have NFP, non-farm payrolls. That's going to be a big factor in the market. We'll actually take a look at TMF real quick. Again, if you're the type of person who wants to try to time the Fed and thinks that the Fed is going to cut rates very soon, then IEI, TMF, these are things that you're going to want to be going long. Now, the last time I charted up TMF, we actually talked about an ABC structure taking us down to the 641 range, and we flipped that area from support now, right? And they're actually trading below it. We're going to zoom in on our charts real quick so you guys can get a better understanding of the price action and some of the key levels that I'm really paying attention to. Now, one thing worth highlighting is that last time we had a big move down and we got a very strong move up. We came up right towards our 50% retracement level and then actually continued that downtrend. So as we zoom in here, right, it's going to be very important to be mindful of our major retracement levels. So 641 was the original target for that move down that ended up hitting. And, we actually have broken through our levels. We need to be a little cautious here, right? And the reason being is because there's some gaps on the chart, right? This chart is very gappy. You can see we have a gap up to fill here. We have a gap up to fill here, very similar to TLT, but we've also got a gap down to fill. So the setup that I'm actually looking for right now would be an inverse head and shoulders, and it would look something like this, right? So, here's your left shoulder, here's your head. And if we come down, I actually want to see us hold above the gap fill and put in that right shoulder. And if we can hold above the gap fill on any type of a pullback in TMF, then, I would be looking to potentially play this for a trade up here to the gap fills that we do have up above, right around that $7 price target. So that's kind of where my head is when it comes to TMF. We'll see, can this actually turn into an inverse head and shoulders and hold above the gap fill? All right, and then you have a very good defined risk to reward ratio, right? If we end up getting a pullback back towards this area over here, right above, then essentially, you can, have a stop loss right when the gap starts to fill, or you can have a stop loss below the gap fill, however you want to play it. But essentially, you would look to see if we can get a move like this and take us up again to this gap and also to this gap here with a very defined risk to reward ratio. Let's actually break down the big dog here, TLT. One thing worth noting is that we have seen actually record amounts of inflows into the treasury markets, right? And into bond ETFs. The thing is you can't tell, right? Price action doesn't tell you that. And the reason being is because we've seen Janet Yellen flooding the treasury market, right? Just pumping massive amounts of treasuries into the market. Not only that, but we have Japan and China also selling massive amounts of US treasuries as well. And so even though that there's been such an increase in demand we haven't really seen much follow through in the price action for TLT and a lot of these bond ETFs, and we've seen Treasury yields continue to rise because of the factors that I just described to you guys. Now, one thing that's worth noting, all right, TLT again, going to be a very similar chart to the TMF, but this line right here, these are actually anchored VWAPs. These aren't moving averages. And so we talked about in the last video that we're squeezing between our monthly anchored VWAP and our weekly anchored VWAP. It's August 31st right now. We're going to start a new month here soon. So we're going to have to adjust, our, anchored VWAPs for the new month of September. But what we're actually doing is we're approaching the quarter to date anchored VWAP. That's going to be exactly at the top of the gap fill for TLT, right around $98. So, is this going to be an area where price action gravitates toward? Remember, big institutions, big players, market makers, hedge funds, they tend to buy and sell at these anchored VWAPs. And you can see that, on the when we had the weekly anchored VWAP, as soon as we approached that area, buyers stepped in, right, and kept pushing it in. So it lets you know on a shorter term basis that there were buyers for the Treasury market and and pushing things up higher. If we come up towards this quarter to date anchored VWAP, it's going to be really interesting to see, right? What does big money do at those points, right? Do they become sellers and start to take profit from some of their shorter term positions? Or is this an area where we start to consolidate and push higher for the second gap fill up and potentially even the year to date anchored VWAP, which is going to be around 102? But when it comes to main levels, if we break below 96, all right, $96, really we're going to be targeting the $95 range and eventually even the gap fill down here just above $93. And this, you could have the same potential trade set up here as well, right? Talk about inverse head and shoulders. If we can hold above the gap fill, then we would look for the right shoulder to form and to be put in. But ultimately, if we break through the gap and start to fill the gap, that's going to invalidate the overall structure for the inverse head and shoulders. So, there's no reason to rush anything right now. We're seeing lots of indecision candlesticks, right? We're seeing two dojis in a row. That's just, it's very textbook indecision candlesticks after a very strong rebound. If you guys are new to the channel, I feel like I've been one of the only people actually telling people, hey, there's a very strong chance we're going to come down and fill this gap here to about 95. And I've been talking about this gap since November of 2022. So almost an entire year. I do have some long positions in TLT. I did trim some of those. I got in here and then I got in here as well, right in these two areas. And, obviously those positions are looking nice now. So now, it's really not a bad time to sit on some hands. You don't have to force any trades, right? There's always going to be another day, another opportunity. And, FOMOing into things is one of the worst ways, to blow up an account or, lose a lot of your investment funds. So I don't want you guys to do that. Hopefully you guys enjoyed today's video. Smash that like button, subscribe to the channel. Don't forget to check out the investment intelligence newsletter, right? You can get these articles sent straight to your inbox every single week. It's completely free. You can sign up with the link in the description or the pinned comment down below.